Guys, it's your boy MP13 coming at you with this options trading video. So, get right into it. Options are very risky, but very rewarding, but very risky. Just like trading, options are very risky. I must say that a couple of times. Do not go all in on options, okay? You shouldn't go all in on stocks either, but do not go all in on options. I'd say maybe buy one at a time, two at most, okay? Small ones to start and take it from there. So, options. You have the right. Options is basically the right to buy 100 shares of any stock. The right. So, while I'm speaking of that right, do not at any point exercise your right. So, I don't know about other brokers, but Webull, you might want to select this. Do not exercise DNA at expiration. Do not exercise at expiration. I'm going to say that. Do not. There's no point. There's more value in your contract than the share, to own the shares. So, what are options? There are two ways to play options. You could buy a call or buy a put. Call is betting it goes up. Put is betting it goes down. So right now we're looking at wish calls. The stock price, if the market was open right now, the market's closed right now, is 9.98. Okay, that's that line right there. It tells you the stock price. These numbers here, these are the stock strike price. These are all the strike prices. Okay, so with calls, you want to bet. Obviously, you want to buy the strike prices that are above the stock price, like 10, 10, 10, 50, $11. For puts, you want to buy the ones that are going down. So below 9.98, 9.5, $9, 8.5, 8, etc. What you don't want to do is buy a put or a call that's so far out. By so far out, I mean 9.98 is wish. I might want to buy a 10 or a 10, 50 or $11 call. There's no point to buy these old calls 27. Yeah, it's cheap, but look at these Greeks. You don't even know what the Greeks are. So the thing about Webull options is it updates every 15 minutes unless you subscribe to something, yada yada. Okay, so we're going on what I'm seeing right now. And what I'm seeing is that delta, gamma, and theta are 0. Those are the Greeks. There's 5. Delta, gamma, theta, rho, and vega. So again, alright, so what are the Greeks? The Greeks are the percentage, basically the numbers that represent the changes. So, like I said, it's the right to buy 100 shares, right? So these numbers reflect, by math, you want to do times 100. So let's say this $10 stock price, okay? This $10 strike price. The delta is 42. The theta is 0.6, and the gamma is 59. Okay, so based on the delta and theta, okay, so delta is the amount that the option will go up if you're right. Every dollar or point it goes up. Okay, every dollar or point it goes up. That's how much it will go up by times 100. So basically, you go up $42 per point or dollar per contract. So if you buy 10 contracts, it will go up $420 per dollar, pretty much, from 10 contracts. I think, yeah. My math is off right now. I smoked, sorry. So, okay, these numbers you want times by 100, the Greeks, because it's the right to buy 100 shares. The implied volatility you see is a 90%. Implied volatility, okay? So let's go with the delta again is that's basically the money you can get, the positive. 42 cents or $42, okay? And theta is the decayer. It's 0.6 cents. So if I'm wrong, or the longer I hold the contract, because contracts, the longer you hold them, they do decay over time, contracts, okay? So contracts do decay over time. Is 0.6, okay? So that's 0.6. The gamma is 59. The gamma is the changer of the two. The delta, the positive, the theta, the decayer. The gamma changes them. So gamma is pretty high, 59. So it would change 59 cents will reflect on the delta or theta, okay? With the higher amount of volume, the more the stock is moving and such, these numbers change, okay? Implied volatility is the volatility percentage. So you kind of want to try to buy a contract like this one isn't terrible because even though the gamma's high, if you're right, you're right. So it's pretty good because it's not over 100 volume percentage. I think anything 80% or lower is pretty decent. The lower, better. The delta to theta is pretty good on this because it's a big ratio difference. But this is a July 30th contract. So this is a July 30th. These are all the dates. If I'm going to buy a July 30th contract, and today's July 29th, let's say the market was open, it's closed now, I would have had to sell it today or tomorrow, because tomorrow's July 30th. So if I sit on this contract all day tomorrow and I don't sell it, it's going to expire worthless. So whatever money you invested in it is all gone. That's why options are very risky. Because if you're wrong, you might get caught bag holding, or contract holding in this case, and now you're fucked. Because now you just lost all your money. That's why I say buy little by little. There's a way you can stop losing all your money. I'll tell you later. So, okay, what you want to try to do is buy a contract that's either pretty far out at a good rate. Like this is December 17th into the year. This is an outstanding contract. I mean, look at that delta of 60. That theta is an eighth of a cent. So that's a good ratio. But look at the premium. So this is the premiums, the bid and the asks. That's what they're called, premiums. So this one would cost, it looks like a pretty sweet Greek-wise, but look how expensive it is. You think, oh, it's $2.35. No, it's times 100. So it's going to cost you $245 for one contract. Right now, if I bought it at the ask of $245, I could buy or sell at the market in the limit, okay, or a stop. So let's say I want to buy it at $240 or $235, boom. So you could sometimes buy ask for a buy or sell in between the bid and ask, and sometimes you could sell at the market or sell at the market. You never want to buy a contract at the market, but you might want to sell a contract at the market because let's say like tomorrow, this July 30th put I have, I want to sell this tomorrow before I lose the money invested in it. Okay? So, my average price on this, I don't remember what it is. Anyways, so you want to buy and sell and make money, right? So I could sell this at the market maybe tomorrow. Now you can't always sell at the market because the volume is very, very volatile and it's moving too much, and if it's too much volume, it won't allow you to sell at the market. But I've sold at the market a few times, even with high volume. Sometimes it works. So I'm going to be looking to sell this tomorrow because this put not only expires tomorrow, but Wish itself is going down. So that was a $10 put I bought, so it's below $10, so I can make money. That's if the Greeks don't change, because the Greeks change every day, and if things change too much, I might not make money on this. So those are the things to know about options. There's expiration dates. There's premiums. That's the amount you pay or asking, buying or selling. They expire worthless if you don't sell them. The Greeks are important, okay? Delta, again, is basically what you make. That's your positive. Theta is the negative. The theta, it eats 5 cents worth of premium. Not 5 cents worth of premium, but it could. If the stock changes, if the stock goes down, especially, but over time, theta just increases and it eats away at your option. So theta is a bad guy. I don't really need to get too far deep into what all these are, because I'm trying to tell you the basics, because you need to know the basics, because once you start making this a little more complicated, you're going to get scared from it. I started just buying options like little by little before I even knew truly how to play them, and now I'm so comfortable buying them that I'm buying them like crazy. So again, it's a brief explanation, but you got your calls, your puts. So again, this stock, I want to buy a call of 10 or 10.50, and it goes to 10 and 10.50, or even 11 or 12. If it goes up to 20, that day, I'm going to be making a killing. And if it goes up to 20, you probably can't sell it at limit, $10 limit wise. So you might have to try to sell it to the market even, which, you know. And so that's the call. And then the put, again, you want to try to buy the put strike price. That's lower. So you want to look at these bad boys up here. Don't buy down here. That's stupid. Why would you buy? So you don't want to buy a put all the way down here, 10, 50, or up here, I should say, because that's so high. Like, first off, that's the opposite. If you want to buy a high strike price, you buy a call. So again, it's some people just don't even understand that simple. But when you're buying it, you see the calls, you want to go down. Puts up, you see it reverses. Anyways, so buy a put if you're betting on the stock. So if a stock goes to its all-time high and it's fucking pretty good, it ran, or even if it's gone slow creeper like Pepsi or something, and this hits Pepsi's near its all-time highs. So what I've been doing is when it hits the peak for the day, it looks like either after lunch hour, power hour, if it goes up, if it's at its peak, you might want to buy a put because next day it might open lower because, you know, stocks don't just go up. Stocks go up and down. And if a stock is just oversold, like let's say this shit jumps off a cliff and it bounced off. If you time that call, boom, you can make a lot of money on that bounce back. But again, they're very risky. But you want to look at, again, the expiration dates. You want to buy the longer, the furthest out it is, the more expensive the premiums are, and the better the ratio of the delta thetas. So ballers make money on some of these because they could buy so many, and it's, you see the price of because Wish is gonna hit $10 by the end of the year. I mean, it will. So you can make money on these far out ones, but you're spending so much money and you're risking so much money. Remember, if you're wrong, you lose the money. You can say, oh, well, you just said Wish is going to go eventually, but the theta will eat away eventually. So, you know, you want the point about options is you want to time it right. If you get a precise point entry, you can make good money out of it. But if you're wrong, you could lose it all. But again, let's say you're wrong, try to sell it to the market before you let it expire. Something. I got one. Let me show you guys. I didn't alert this because I was, someone else told me to buy this, and I'm like, I don't know. I like to buy my own shit. This was a terrible call, 4.5, and it dropped 3.6. So this is going to expire worthless. I paid more money than this for it. Let me show you. So I paid $37.50. So my mid price, I paid $25 for this. 25. No, my average price is 40. Sorry, my average price is 40. So I paid $40 for this call, and I lost all of it. So this account I've been playing with the options more, and so I don't really care about it too much. But you see, now it's pretty much going to be worthless because tomorrow, July 30th, I lost all my money. So when you're wrong, you could really be wrong. And if you're really wrong, I should say, Joe, honestly, just take the L. Like if it looks like you might be wrong, like when the bid and ask on this one was 5 cents on bid and 10 on ask, I probably should have just sold it so I could kept my $5. But no one's gonna buy this. There's a lot of asks on this that 5 cents because those are the people that were wrong. So no one's gonna buy this at 5 cents. They would be a fool because it's gonna expire worthless. What is it? Let me show you the theta. Look at the delta, gamma, and theta on this worthless contract. The delta just dropped down. The more it dropped down, the theta got closer to the delta. Look at that. I would never buy a contract that bad. You know, the gamma's higher than both of them. The delta is 5 cents. The theta is 1 cent. So this is a worthless contract. This is why it's dangerous. But you know, you could buy good ones. This is a good one I bought. And why this one I alerted because look at this. October 15th, 2021 expiration date, a $4 contract. Okay, delta is 51 compared to half of a cent on theta. The gamma is good amounts. Okay, this is a good contract, and the applied volume. I don't want to keep. It's a good contract, okay, and so I can make. I paid 65, those 64 average price. So I'm up on this. I'm gonna hold this because this got a new price target of $20. This was a great contract. This was a great find, and it was a good price. So hopefully it goes up, and not whatever. But you could swing these two. Like, so this went up a little today, and the bid on this was 65, and the ask was 70. So I could have sold for 1 cent or $1 per contract and made some money, and then bought it back at 60 cents today when it dropped, and it wound up dropping after hours a little. It was at 3.7. Someone's trying to hold this back, but this is a good contract. Just look at those Greeks. Far out expiration. Didn't cost me too much. Great contract. See, you even got 200 on each side trying to buy it. So that's a good contract. So you want to keep in mind, you don't want to, like, July 30th contracts. Every Friday on Fridays they expire. Contracts expire on Fridays. So you don't want to buy a contract on Friday that expires on Friday unless you're trying to day trade it and it's just moving crazy. And you time it right. Otherwise, you're just going to lose all your fucking money. So again, I don't want to be responsible for people losing all your money. Buy one at a time to learn it. I say buy even the penny ones because they're like 5 cents and stuff. Or buy like this one I told to buy. It went down a little, but you could buy one. And just like with stocks, you can average down or up. So if I bought it at 65 cents tomorrow, and then it drops and I buy it at 50 cents, again, another one, my average would be about like 57 cents. So you can average down and average up on contracts too. Okay, so if you have any questions, let me know. I'll try to keep it brief. I didn't explain Vega and Rho because Rho is completely useless. Vega is just a reflection of the volume and the volatility. I don't want to get too much into that. I say just, again, try to buy an option that has a good delta to theta spread and with a low volume. This volume is pretty high, 145%. It's still not as high as they could be, like 200. They can get pretty high. But I don't really focus on that. I try to just be right, It's just like with sports. You're betting on two teams. You're betting on the bet and these are bets, okay? It's not really gambling if you play it right, but, options can be risky. So I hope this helped people. If you have questions, hit me up. I've recorded this video a few times, so your speech, you forget what you want to say. But hit me up if you got any questions. I'll probably make another video if I feel like I need to explain further. Thank you.